So what I want to do now is basically walk through our latest outlook of the industry, how we see things shaping out. And I called the presentation Plus ça change. The more things change, the more they stay the same. And the answer to that question is yes, no, and maybe. So I've covered my bets. Some things will stay the same, some things will change, and some things are still open to issue there. So I just want to run through some of the things that we're talking about. Our research philosophy is very simple. We don't believe in models, we don't believe in all of these things here. I think Tony mentioned this morning the same sort of thing here. You've got to look at the longer term issues, you've got to look at some of the trends in that there, and you've got to apply a bit of common sense. And those are some of the fundamental principles we always try to ignore, to not ignore. My industry experience started at the end of the first recession. So I've lived through every single semiconductor recession except for the first one. And I feel cheated that I missed out on that first one there. But it has taught me a lot about the dynamics of the industry, and I guess what goes down comes up, what goes up comes down. So you do learn to have a bit of faith in the industry, and I think that's something which, when times are not so good, people tend to lose faith, lose confidence in it, and you shouldn't do, because the industry is still hugely dynamic. And we've heard from the presentations this morning and some of the opportunities that are there. My life experience started a little bit earlier, and that was equally demanding. It was equally fascinating. And the three things which stick in my mind was Mrs. Brightwell. She ran the corner shop. She taught me so much about organisational things, efficiency, and stuff like that. I grew up in the transition of music, and we heard all these incredible sounds which changed the way you behave, and it taught you about a lot of issues, teamwork, playing together and stuff like that. And it also was a very interesting experience in terms of in my days of being in the military here. We did the drill, we used to do lots of drill competitions. Again, teamwork, moving within precision and things like that. So great experiences. And it was a good stead for the semiconductor industry, which has been very kind to me over the years. We always look at four aspects of the industry when we measure things. We look at the economy, we look at the fab capacity, unit demand, and the average selling price. And we believe that those four issues there are very telling in terms of giving you an indication of how the market will behave. And when you look at the economy, of course, we've had a serious problem since 2007 when the financial crisis hit, and it still is not over. We said back then that it was going to be 10 years before this whole thing got sorted out. And it's pretty much on track for being 10 years. We've got 3 more years to go through, but it's pretty clear that there's still lots of obstacles to overcome. But in the end, it's still not that bad. The industry is still muddling through, growing, not in the same growth rates that we had before. 2011, we had a lot of disasters in that year. It's amazing the number of disasters that happened. But the GDP still grew 3.8%. In 2012, it grew slightly less than that, but there were a lot of crises last year. Unresolved crises, financial crises, the euro crisis, the US budget crisis, and things like that. All of these things that really did not instill much confidence in business to invest, to grow, and stuff like that. So we really are throttling along, cruising really at slow speed. And this year, again, has been still the aftermath of that, coping with the high debt, the low growth, and those issues there. And the net result is that most organizations are still not really mindful for investing aggressively in the future. So most companies have lots of cash, they're not poor, they've got their money, they're just not really spending it, or they're spending it very cautiously. And that, of course, is causing this, not so much of a crisis as much, but it's just the uncertainty of everything. And a couple of days ago, of course, we had the issue with the American government's now shut down. I mean, these aren't good messages to send out to the world that this is a great time to invest and stuff like that. So we really are still in this lack of confidence type period here. And what's happening, of course, is that everybody's just waiting and seeing, waiting a quarter. If this quarter is reasonably okay, we'll wait another quarter. We're still waiting, waiting, waiting. And the whole point about that is that the more you wait, of course, the more, by the time a trend becomes clear, it's too late. But we're going to wait until the trend's clear, until we do something about it. So already we're building ourselves up for an overreaction to something because we've let it go too far. which is not surprising. In terms of the GDP growth trends around the world, this is the IMF data from July. It has been cut back a little bit here. When you look at the forecast they gave in January this year or in this time last year, each time it's been cut back very slightly by a decimal point or so. So now we're looking at 3.1% for 2013. In January that was 3.6%. So we're looking back, throttling back here. The same with the advanced economies, 1.3% down to 1%, and 5.6% down to 5%. So everywhere the outlook, as we move through the year, the outlook has become a little less more cautious, less slightly aggressive. Their forecasts in the year at the moment do tend to start off quite aggressive, or not aggressive, but quite positive, and they gradually, as the crises don't get resolved or more things happen, the confidence doesn't really recover, and you see this little cutback here. It's almost like the sign in my pub that says free beer tomorrow. The good growth rates never come. It's always tomorrow, tomorrow, tomorrow. Just looking at each of these areas, see, these are the track record here for the advanced economies, the volume, the world, the US and the Japan and Europe there. And you can see that going back to 2005, 2006, before we had the financial crisis, we're still looking at growth rates there that are significantly lower than they were before we had the financial crash. So the general feeling of the economy is that we're not really going back to those very high growth rates that we had before the crash, but 3%, 3.4%, if it gets up to 4%, that would be good. So it's not all bad news, it's just that really the confidence in investing in particular is not high. The bigger problem, I think, is really that there has been a change in the outlook for the emerging economies, the BRIC countries. And there we've been used to the 10% type growth rates, and now that's being throttled back to sort of 7 and 5, 6% type growth rates. And that certainly had a lot of people worried, but then on the other hand, you can look at that and say you can't keep growing 10% a year forever. So again, there was an inevitability that these high growth rates in these emerging regions would slow down after 10 years of very high growth. And 4 or 5, 6%, 8%, still reasonable numbers, it's just different. And people are adjusting to that, they're adjusting to the meaning of what does this mean for me, industry, and so on. The oil price has always been a reasonably strong trigger for the economy here. That is changing now. I mean, this impact of fracking has had a significant impact on the American economy. It's had a significant impact already on oil pricing. And that's changing the world slightly from the way that we now need to look at this in terms of the effect on the economy here. And you can see that even since the beginning of this year, the oil price pressure on the price of oil has come under extreme pressure from the fracking institute. The same thing on natural gas. The impact on there is quite significant. And so that again is a changing dynamic, which means that it's a positive changing dynamic, because it does mean to say that we now have an alternative source of energy for the whole thing here. So longer term, that's good news for the economy, because when the oil price does tend to go up higher than we would like it to be, and that has a dampening effect on the economy. The big issue we have to address, we have to face up to, is interest rates will rise. And we've already seen the effect of that when there was some indication of the end of quantitative easing in the United States. The whole market reacted overnight, and the whole thing was almost pushing itself into recession again on that news there. That change has to be managed. I mean, it's going to happen here, it's going to happen sometime there, but it's still a risk, a hurdle to the economy that the world has yet to live through, and we have no experience of how to manage ourselves through that crisis, but it's going to happen there, and eventually at some point in time, they're looking here, this is a chart from the Royal Bank of Scotland, they're looking at 2016 as being the period of when this will end, and it could even be, my feeling is, I'm not an economist, but from what's been happening, the words coming out of the UK bank, the words coming out of the American Fed, is that that might be sooner than that, 2015, than later. But it has to be lived through, and that is going to have an impact on the economy as well. The economic climate, this is data published looking at how industry feels about itself. And the orange line there is neutral. So you can see that pretty much everywhere around the world, whether it's Asia, the Western Europe, North America, people are still not confident, and it's united everywhere around the world. It's not simply one region better than another one. Everybody around the world is just simply not confident. And when you're not confident, you don't do anything. So you hold off and wait for the better times. And that's really where we're bumping along here on the bottom. And of course it is affecting the chip market, and you can see that in the data as well. So in the end though, doing nothing is not the answer. I mean, you have to take this long-term view of life. You have to take the view that things are going to get better. There are lots of challenges. But one of the things about having been in the chip industry and the market research industry for so long is I keep going back to presentations made in 1980, 1990, 1970 even. I've got presentations I made in 1970. And the first slide always looks at the economy and it lists down the things that are worrying about. Whether it's this war or that here or that what else there, or the impact of Japan taking over the world, or the impact of whatever. I mean, there's always a list of issues there. So, you know, issues are around, they're always there. It's just we seem to be paying a little bit too much focus on them. So we have to get a balance back in there. And because some of these investment things, some of the things we've been talking about today, Joe's presentation, you're looking at 10-year windows. So you've got to do the work now for this stuff to be on the marketplace when we need it in 5 or 10 years' time. We keep underestimating the lead time that it takes to develop some of these technologies here. So you can't run everything on a shoestring. There's a good phrase saying, don't waste a good crisis. Okay, that's a truism which is very true, see? But at the same time, you know, don't look down, because it doesn't look very good when you look down. You've got to keep looking ahead, you've got to keep focusing on the opportunities that are ahead. In terms of the industry outlook, you know, one of the real fundamentals of this chip industry is that these peaks and troughs are a natural part of the fabric. 60% year-on-year growth changes are normal. This is not abnormal. This happens regularly. It happens on the up, it happens on the down. And it doesn't matter where you take it. Whenever you look at the transitions in the industry here, you will see swings of 40%, 50%, 60%. You know, a benign one will be 30%. But 30% change year on year from growing to shrinking, shrinking to growing again, these dynamics are fundamental. And when people talk about the industry maturing, the industry slowing down, the dynamics getting less, forget it. It isn't going to happen. There isn't a single data point in history that would support that hypothesis. So you better believe, therefore, that we're going to get these kind of swings in the future. And my feeling is that because everything has been cut back so much over the last 3 or 4 years, that when this industry does rebound, it is going to rebound even stronger than it has done in the past. And you'll see a huge dynamic shift in the positive direction. In terms of the economy, we talked a little bit about that. Of course, it is the fundamental driver for the chip industry. And it has been pretty consistent that if you do get an economic disruption, it does cause the chip industry to either slow down or go into recession. So that is a very fundamental point there, and that's very clear. And I think, you know, that we've still got to take that into mind, and there are still lots of issues there, lots of minefields still to cross. But it's not the end of the world. Life is going on. Life is around us here. Things are being invented. Things are being purchased. And the overall economic strength is not dynamic, but it certainly isn't in recession. But of course, it still has lots of things to deal with. The strategic importance of integrated circuits, I think, has now been realized. We did this chart as part of the Commission 450mm project, and it was pretty clear then that we figured, or we calculated, that the chip industry itself, it may only be 1% of the world's GDP in its absolute value, but its influence in the whole food chain is certainly 10%. When I showed this chart to some colleagues and friends of mine in Japan, they said, we did this chart 10 years ago. For Japan, it was 20%. The dependency of the Japanese chip market, GDP, on the semiconductor was hugely competitive. When they did this chart for the UK, it's only 6%. So again, it varies from country to country in terms of where we are, but the chip industry itself overall does support about 10% of the world's GDP. And of course, you heard from the Commission initiative now, it is this realization that the chip's significance, its strategic importance, is something which has made them very aware of these initiatives and has been one of the driving factors behind their thinking. The unit demand, my second sort of point of contact, the long-term demand for units has been incredibly consistent. This chart goes back 30 years. That's as far as the data goes back. And I'm sure if you looked at it earlier than that, the data will be as consistent. The black is the monthly data. Now, why the monthly data varies so much on a month-by-month basis is purely because of human inefficiency, the way we run our factories. That is management's decision why that unit demand goes up and down on a monthly basis. Over a drink tonight, I'll tell you exactly why that is, okay? It does that. When you look at it on a year-on-year basis, January versus January, February versus February, that gives you the red line. And that's on a nice little cycle there, it just floats through there. But then when you look at the dotted red line, that is the computer average of the red line. The average year-on-year growth on units has been 10% per year, 11% per year for 30 years. That's an incredible statistic. The amount of units that we produce is growing 10 to 11% per year. And when you think about all these applications that we've been hearing about this morning, it would, it takes a very brave man to say that we're not going to keep on growing units, finding new applications, new markets, because we've seen an awful lot of those being talked about already today. So I think, in the next certainly 5-year perspective, that's a pretty safe number, and I think it's safer for a 10, 15-year perspective as well, because we keep finding new things to do. We talk about the Internet of Things. Okay, the Internet of Things is lots of things. Each one of those things has to have a chip in it. That's a unit. So again, these unit demand is got plenty of growth to grow, and there's no reason why we can't keep that 11% number intact. The better news is, when you look at that in the last, this just looks at it over the last 3 or 4 years, it goes through peaks and corrections, where you tend to overbuild inventory, correct, overbuild inventory, correct, and you find that it's pretty consistent on that growth rate there in that recovery type period before it then corrects itself and plunges down. Since we had the Lehman Brothers collapse, that very first sharp negative one there, everything was cut back dramatically. The unit recovery from that Lehman Brothers collapse was much sharper than the previous trend recovery. We then had the Euro crisis, which was the second of those dips down there, and the recovery back from that was much sharper. So and the third one is this last one here, when we had the recovery, it slowed down at the beginning of this year, and now it's recovering again. People don't think about this, they don't really appreciate how strong the unit demand is right now. The recovery of that unit demand is really very, very steep indeed when you look at it on a month-on-month basis. These recovery patterns are very robust because we've cut back everywhere in the food chain, the inventory has all been depleted. We're now living off hand-to-mouth, of new wafer starts, and when you slow down, you have to then rebuild again. Catching up is hard, and you have to suddenly run like hell to get back up there again. And that's still in a fairly benign position. So there's new data coming out tonight. I'll be able to tell you what the next data point for that is tomorrow morning. But the fact remains is I expect it to be very much on that curve there. We're seeing this unit recovery is already happening, but people don't feel it.